All right, everything looking good. We are live. Somebody let me know in the chat. We're coming through loud and clear. But in the meantime, let's go ahead and get this stream started. All right, welcome back to the channel, Crypto Trend Trader, with our Friday morning market wrap-up. Before we get started, I'd like to remind you it's not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. It is Friday, 11 a.m. Eastern Standard Time on August 19th, 2022. And boy, have we got a lot to talk about. So, crypto falling out of bed, losing some key support levels, as expected. We talked about the key levels that needed to hold and what a likely pivot would look like if we went to the upside and to the downside. You guys know, obviously, as of the last stream, and then obviously in the trade group as well, I had closed out all of my crypto positions. We did get very, very lucky and sold that absolute top. Obviously, pure luck, no technical analysis involved. So from there, we're just waiting for potential area to see what's happening here. Resumption of the bear trend is obviously my base case. As far as stock market as well, obviously we have basically picked the exact bottom and nailed the top as well. Came all the way back up to the 200 exponential and simple on the daily. Now we're seeing clear signs of at least the beginning of potential topping. So what are the things that we're looking out for? As always, we're looking for what's controlling the market, what the narrative is, and what that means. And we know for a fact, based on the last year or so, that as long as the 10-year rate, or just rates in general, are trending to the upside and bullish, as long as the DXY is strong, well, we know what that means. It's going to be very, very difficult for risk on assets such as the stock market, cryptos, etc., to move to the upside. Gold, all that stuff. So as we see the TNX and the DXY resuming the very, very bullish uptrends after what amounts to a bullish reset, and now preparing to make new cycle highs, I think it's very clear that that's going to put some serious pressure on assets. So obviously, as we've been calling that out in advance, that was able to give us essentially the predictive nature of what was likely to happen. So we haven't seen a big sell-off in the stock market yet in the same way that we have on crypto. And by big, I mean, Bitcoin down 8% in a day. It's not like the end of the world by any means. We've all seen much bigger moves than that. But, it always sucks when you take an 8% hit to your portfolio in a single day. That's not cool. So we'll take a look at all those things. Obviously, look at the trends, look at, what we're expecting, look at some key levels for pivots that we would expect to potentially find support, and, where to go from there. We'll talk about some potential for trade setups. Now, typically, obviously, in a bear market, after we have a nice move to the upside, we would expect resumption of the trend, which, of course, is going to be to the downside. So that being said, the trades that we're looking for from here are essentially shorts. Why is that? Well, because if we're trading with the trend, which we typically are. Now, we did take counter trend trades on quite a few things lately. We took bullish trades. They played out quite well, but we know that they're at risk of a lower probability of success, which that's fine because they played out beautifully over the last basically like 6, 7 weeks. But now we have a huge advantage because if the trend in fact does resume to the downside, we'll be trading with the trend. So not only do we now get to sell into the rally and dump on everyone's faces, the profits that we've been making, but we also get to do it from a much, much higher level. And now we're trading with the trend because we're shorting in a bear market. So the probability of success, much better. Now, obviously, there's always asymmetric returns for a long versus a short, because no matter what, an asset can only ever go down 100% and go to zero. But an asset can go up hundreds and thousands of percentages. So while I always prefer to be taking bullish trades and markets to be bullish just because it makes my life easy, the true trades are made in the bear markets. The true, investments or whatever are made in the bear markets. But again, that's when timing comes in. And obviously timing is the most difficult part of the game because you're throwing an unnecessary variable into the mix. So rather than trying to pick absolute tops and bottoms, while I am guilty of it, and, you know, granted, we do have a very high success rate of doing so, you know, we try not to do it, or at least count on doing that. What we really want to do is just pick up that 80% in the middle. You know, we just want the cream of the Oreo. We leave the cookies behind. So we're selfish, okay? And you know what? In the markets, in your regular everyday life, you know, be a good person and, you know, a philanthropist and, you know, put everybody else above yourself. But in the markets, be ruthless and be selfish, because nobody gives a shit about you. You got to care about yourself. I appreciate you, Jay Hoff. Thank you, brother. What's going on, Cool Sheet? What's up, brother? Biddy is sliding down the greasy stripper pole today. It is indeed, as expected. I mean, no surprises here, obviously. So, all right, let's just jump right in. Today, we're going to be talking a little bit about something very important. We're going to be talking about due diligence and the importance of essentially doing your own homework. You know, when you were in school, there was two ways that you could, you know, get grades in school. You get homework, and you could either do it yourself and learn, or you could just copy off your friend or, you know, some nerd and just assume that the answers are correct. But are you going to learn anything? No, obviously not. You're just copying answers. So, you know, what use is it really? I mean, you're just getting grades, but you're not actually learning anything. So, you know, you might be able to pass, but you're not becoming, you know, self-sufficient. And the key of this channel, obviously, is not only to make money, but learning and self-sufficiency, of course. One of the, you know, great minds of history once said, you can, you know, feed a man for a day with a fish, or you can teach a man to fish, and he can feed himself for, you know, a lifetime. You know, maybe subjective to some translation errors. Can't remember what his name was. I believe it was Jesus, a Spanish fellow. So let's go ahead and let's take a look at the TNX. Obviously, no surprises here. We got a gap up. You know, we're already back up here, threatening the top of the range. We do need to be careful for a potential double top around this area. Obviously, we've talked about how it's basically, I don't want to say impossible, but it is 100% improbable for the 10-year to go any lower, especially as we're counting down to essentially the next rate hike. So we already said that I've said it like 36 times and I can't even get it right. 2.83 would be the Fed funds rate after the rate hike that's coming up. If we got 50 basis points, if we get 75 basis points, it's going to be over 3. And regardless, if we get any hikes at all, 25 basis points or more, we'll have a technical breakout on the Fed funds rate from the previous high, confirming essentially that the bond market is wrong and is trash. The stock market is wrong and is trash. And we're likely headed up to 5% on the Fed funds rate. So why all of a sudden is the bond market and the stock market, who's supposed to be all-knowing, all of a sudden wrong? How does this make sense? How could the majority of people participating in the market suddenly not know what the hell they're talking about or doing? Well, probably because we're seeing a trend shift of like, you know, a 35-year trend or something like that, all of a sudden reversing. So people have recency bias. If they're used to doing the same thing for 35 years, which is the majority of people's investing careers, if not their entire lives, depending on how old they are, obviously, you know, we see a lot of, you know, influencers or talking heads or, you know, whatever, paid, you know, contributors on CNBC or whatever, you know, that are probably not even old enough that they were alive back when we had our last bout of inflation, let alone know what it's like to invest in a market, you know, that rising rate environment with inflation, etc. So it makes sense that everybody's wrong and all of these people's brains have been turned to mush from, you know, 30 years of quantitative easing and zero rates, essentially, like trending towards zero rates at least. It makes sense that their brains are all mush. And then with social media, you know, everybody just sees what everybody else says and they look at it and they say, oh yeah, that makes sense. Your like paragraph that you tweeted, it sounds right. So I'll just retweet it and just assume it's correct. And that's where due diligence comes in, because you end up with this mindset of just a bunch of, you know, people whose brains have just been melted, turned to mush, and they can't even think for themselves anymore. So they just assume everything they see is true. Half the time you see an article and there's a title and they read the title and go, oh, okay. And they don't even read the article. So that's like next level form of not doing your due diligence. So as far as due diligence, well, you know what? Let's go ahead and just skip over. we'll talk about these real quick. We'll kind of go in order. So we've been expecting essentially, obviously the VIX has been melting down, lost some key levels, and we've been talking about essentially the VIX bottoming around this level. So we have in the, a couple streams ago, basically, we had this giant descending channel here in yellow, and I drew in a second parallel channel to the first one in white. So when we broke out of the descending channel in yellow, we started forming an ascending channel in white right here with the triangle and all that good juicy stuff, and we've been talking about that. But when we broke down here, we were talking about a back test of the top of our yellow channel, or what is now the bottom of the white channel. And now we've hit that level, we've hit the neutral level, we got down to about 20, and now we're looking for, obviously, you know, exhaustion down here. We've been in the bearish control zone for literally weeks now. We're getting a hard buy signal again after multiple hard buy signals. Basically just a bunch of oscillation in this range, buys and sells and buys and sells. So the real indicator is the knife above the two stochastics, which obviously it is. You can see it right here. Is the knife breaking above other previous levels? And we can see it took out this high right here. So it clearly is. So the knife is already breaking out. We're getting the hard buy signal. We're still very much inside the bearish control zone, obviously, which is, you know, at 20. We're still down here about 13 or 14. So probably a day or two away. So we could easily come up here, get rejected, roll back over. Volatility goes back down. Markets continue to melt up, and, you know, everything's great. But in all actuality, what we're actually expecting is, you know, we've hit all our targets on everything almost perfectly. We were able to basically, all our targets got hit to the downside all around the same time. We saw ridiculous amounts of confluence. We also saw the end of the quarter, the end of the half, everything lining up perfectly for a beautiful bounce off of essentially the 200 weekly moving average on basically every asset in existence. So when we got that bounce, of course, it resulted in a massive, you know, bull rally to the upside. And now, of course, all of the brain dead talking head people or whatever that were not expecting the rally to happen, now they're all saying, well, now we're back in a bull market. Everything's good. The market's smart and they're pricing everything in. It's forward looking. The Fed's going to pivot. All of this bullshit. But obviously, none of these brain dead people have any actual math or science or, you know, reasons for the Fed to pivot or anything like that. They're just using their like mush brains and repeating what they hear from other people. So now let's take a look at what's actually happening. So if the VIX continues to roll over here, you know, and starts pushing back to the upside, even if it just comes back up here to like 25 or so, you know, that's a big volatility in the markets. And, you know, at this point in time, we're trading at historically like average or low levels after a massive move to the upside. So it's not crazy to think that even if we were going to continue to the upside, that we would see some volatility in the VIX and at least some people purchasing downside protection at the 200 exponential and simple when we approach them from the bottom, which statistically speaking leads to a rejection and then resumption of the downtrend. But again, I wouldn't expect anyone to know that because, you know, I don't see anyone tweeting anything like that. Of course, I don't have Twitter, so that's probably why I don't see people tweeting anything at all. But you know, if I did, but people aren't tweeting that stuff, or I would hear about it from other people. So let's look at oil. Obviously, oil broke down below the 200 exponential and simple. The 200 simple is now crossing above the 200 exponential. We're getting a hard buy signal. We're seeing exhaustion of the trend, bullish divergence as we put in lower lows on price action and higher lows on our indicator oscillators. We're likely to at least see the minimum back test right here. But in all reality, what we're expecting is essentially we're in this channel. We talked about what happens if we break out of this channel. We talked about the potential of it happening right here and what the measure move would look like. But you know, we obviously were very clear. We need to see a close, an open, and a close outside of this channel before it's a confirmed breakout. And you would want to, you know, participate in what amounts to a, you know, breakout, you know, continuation rally position. So that being said, let's just say, for instance, that's what's about to happen right now. You know, we will basically be, you know, the potential to take this exact trade setup is what we'd be looking at. Because, you know, let's say today we close outside of here, we'll have basically closed at that level, and then we'll open outside that level, and then we'll close again outside that level. And at that point in time, you know, we would take a long position for what would amount to essentially a move back up to the top of the range for another lower high. We would look for, you know, this measure move from the breakout point, and, you know, likely takes us up somewhere around, you know, some of this other like little clusters of resistance. But, you know, back test of 100 doesn't seem crazy, a little 10% move, and then we'll see where it goes from there. But obviously we're seeing, you know, everything that people were talking about about oil coming down and energy coming down and commodities coming down, and how that was the peak inflation, and now it's bullish and the Fed's going to pivot and they beat inflation and the market's forward looking. All those narratives will literally blow up in their face if all of a sudden energy prices start to go up again. If energy continues the bull trend or spikes to the upside, if commodities continue their bull trend or even get a bullish retracement before the resumption of, what amounts to them having already topped out and going into a bear trend. And now keep in mind that, what came first, the chicken or the egg? Does energy price spike lead to the recession, or does the recession lead to, the decreased demand in commodities? Is there some kind of correlation? What's the causation? You got to break all that stuff down on your own and, create a flow chart or whatever. But, I've been through all that many times. Okay, so let's take a look at what we're talking about doing our due diligence today. So obviously we have the, I think we're just going to skip the Dow and just go straight to the S&P because that's what we're going to be focusing on today. But as far as the Dow, what happened? Broke down below the 200 exponential and simple after showing weakness when the 200 simple crossed above the 200 exponential, telling us there's a high likelihood we still put in a higher high, but we're seeing exhaustion and the trend is likely to roll over. We then break down, find temporary support, put in a lower high, break down, put in another lower low, and then from there we backtest the 200 exponential and simple, which we get rejected. And then at that point in time, we confirm into a bear market, put in a lower low, lower high, lower low, continuation to the downside. We finally hit key levels, 200 exponential and simple, actually 200 exponential only on the Dow and the S&P, but, many other assets hit the 200 exponential. But that being said, that's on the weekly. We basically hit key support levels that with a 5% probability to see a powerful bounce. Now, it's not because of manipulation. It's not because of, some crazy market factor. It's because that's what everyone looks at and says, okay, we're hitting a key level. We're likely to get a bounce. Everybody sees us hitting the key level and says, well, we're all likely to get a bounce. So everybody buys in. We start building momentum to the upside. The trend lasts long enough that people start feeling that FOMO, getting excited, and then they end up buying in after the move is already completed because they hear people talking about how now all of a sudden we're back in a bull trend. Well, are we back in a bull trend? Let's look. Well, the 200 exponential and simple are still angled to the downside. The 200 exponential here flips blue. We're on top of price action for the 200 simple. So are we in an uptrend again? No, because the 200 exponential and 200 simple are not both blue. Just the same way that when we see a single 200 exponential or simple right here, we're not in a downtrend. So we have to stick to the rules, which is one nice thing about having a factual rules-based system that you can literally write down on a piece of paper. And when you start feeling FOMO and you look down at your, trading plan and say, oh, okay, according to my trading plan, even though I'm feeling the FOMO or my emotions are taking over, I can look at this trading plan and just check off boxes and say, okay, if this, then that, if this, then that, if this, then that. And that's how you win at this game until you get a hold of your emotions. So that being said, all we did was just backtest key levels. We bounced off of key support and we backtested key resistance. Are we still in a downtrend? Yep. Are we going to continue the downtrend? Probably. Does it seem likely that we at least push down and retest some lows to see where we find support at? I would say with very high probability. And that's likely taking place right now based on what we see. As long as the dollar is strong, the DXY, as long as TNX is strong, and they're both in bullish uptrends, we know from the last, what amounts to a year of, positive movements, that it's very, very difficult, or, basically this whole year, I guess you would say, it's very, very difficult for risk on assets to move to the upside while these are also moving to the upside. So the bond market's getting wrecked when, they're rising. The stock market is getting wrecked when they're rising. Gold's getting wrecked. Crypto's getting wrecked. So where do we hide out at again? Well, we know. It was energy for how long? It was commodities for how long? So what is likely to happen if we see all of a sudden we're flipping back to the same environment we've been in for the last, 7 months leading up until basically, I should say 6 months, because really it was the first 6 months of the year. And then, basically for July and so far August, we've seen essentially the reversal of those trends. So if we now resume the trend, what does that tell us? It tells us probably energy is going to keep going up or go back up. It tells us probably commodities are going to keep going up or go back up. it tells us, DXY and TNX and, VIX all going to be bullish again. So everything that was bearish while those were bullish is going to be bearish again, likely. Now, of course, sometimes you'll see, we'll break correlation or something like that and everything, and we'll be able to identify that, obviously. But, it stands to reason that based on what we've seen so far, for this first 6 months of this year, essentially what we've been talking about. So here on the Dow, we see the divergence signal at resistance, key resistance, 200 exponential and simple back test in a bear trend. We see sell by sell on the Jewel Thief. What does that tell us? It's a bearish divergence signal inside the bullish control zone, the best place to have it. Obviously, oops, sorry, I didn't mean to click right there. And then, of course, if we look at the stochastic right here, we're basically at this same little 3 pushes up right here, and now it's rolling over. We're getting a hard sell, but we're not leaving the bullish control zone quite yet. So we don't want to get overly bearish, but we know at resistance is a good place to take profits and then see what's happening. All right, so that's enough looking at the Dow. Let's get into it. Okay, so before we look at S&P, I want to talk about a narrative on social media. And before I show you who I'm about to, I don't know what you want to call it, debunk or fact check or whatever, before we do our due diligence here live on stream together and, make these people look like fools again, I want to say that this piece of data that we're about to look at comes from some people that I like watching. I find them entertaining and, they show a lot of charts and quite useful knowledge, etc. Like the gentleman involved. But the fact of the matter is, we know they're guilty of not doing their own due diligence because we're going to do it in about 5 minutes and debunk what we're about to see. Now, we're going to look at a tweet from someone that I have no idea who they are. So they could have a gazillion followers, they could have 10 followers, but the reference point here is actually a key financial group of individuals. So some credible people with a much bigger microphone than myself. All right, so here we have from Animal Spirits. If you're not familiar with Animal Spirits, it is a YouTube show. Ben Carlson and Michael Batnick. I find them both entertaining as people. But also they do quite a bit of, they show off quite a bit of charts. They talk about narratives, overall, I think they're decent, people to listen to, even if it's just for perspective, not necessarily because you just agree with everything they say. But obviously Josh Brown does quite a bit with Michael Batnick as well. They've got a couple different shows between them and everything. So, obviously well-respected CNBC contributor Josh Brown is. So, big credibility, big voices and everything. But again, not doing due diligence. So I don't know who Connor Sen is. I have no idea who that is. But I see this same narrative being talked about all over the place. Okay. Maybe not this whole exact tweet, but we'll talk about the part that we're going to debunk here. So the tweet says from Connor Sen, blue check mark. So it's fun that we can now say something that's never happened before is going to happen. Okay, so that's intriguing, right? It's never happened before, whatever we're about to talk about. That's pretty cool. So if that's true, that's pretty important, I would say, right? So either choice 1 or choice 2, we get inflation down from elevated levels without a recession. So we've talked about that quite a bit. We've went into depth talking about essentially, what happens with recession, what happens with peak inflation, and been through that like a million times. We've looked at essentially going back data points from 1970s all the way to present. We talked about, the 8 data points we had and which came first, the recession or the peak, etc., blah, blah, blah. So we've done all that before. So we know that part is true because we did our due diligence in real life. So obviously that's not what we're going to be debunking today. We know there's always a possibility, and we've discussed it, that we could actually see inflation come down without getting a recession. But we know it would be something that's literally never happened in, the last, 50 years And we don't have any data points where we can show that having happened. So I guess the second data point must be either straight up bullshit or just not like quantifiable, because you're using like words that have no legitimate like meaning. So he says a 50+% retracement of a major bear market sell-off goes on to make new lows. So how many people have heard recently all the talking heads on literally everything saying we've never had entered into a bear market or had a, in this case, major market sell-off and then go rally 50% and then make new lows? How many people have heard that? I mean, I've heard it all over the place. I've heard it. I don't even have social media, and I have heard it literally everywhere. So people are saying the bottom is in because we've never had a significant sell-off and then a 50% retracement of that sell-off and then go on to make new lows. So let's see if that's true. We can easily look at it. It'll take us 2 minutes. But before we do that, let's look at this statement here and see what part of this is not useful. A 50% retracement, so that's easy, quantifiable, 50%, that's very easy to do, of a major bear market sell-off. So what is a major bear market sell-off? What does major mean? Is major quantifiable? Does that mean a 5% bear market sell-off? Does it mean a 10% bear market sell-off? Does it mean 20? We don't know, because major is not a useful word at all. So, you know, how does major help us do anything? It doesn't help us anyway. So what, I mean, I guess we'll assume that, you know, when we use words like major bear market sell-off, we'll just assume that means 20% from the top, because that's what's considered to be by mainstream a bear market, is 20% down from the highs. It's not really that useful using a term like major, but I mean, I think we get the point. So let's just say 20%, you know, because obviously Wall Street quantifies a 20% sell-off from the peak as a bear market. So we'll just assume that's what Connor Sen means when he says a major bear market sell-off. So that means we're going to have a 20% down from the top, a 50% retracement back to the upside, and then we'll never go and make new lows, because that's never happened according to Connor Sen, who I'm sure probably has hundreds of thousands of, you know, followers or whatever it's called on Twitter. And, you know, the blue check mark, I mean, that definitely means something. That gives you a ton of credibility, so much credibility that there's no reason to even do your own due diligence, because Connor already did it. And a matter of fact, obviously, Connor knows what he's talking about, because Animal Spirits is putting this on their show and putting it out to, you know, hundreds of thousands of people as well. And then that's going to get retweeted by. So obviously, somebody along the way has done due diligence, I'm sure, right? There's no way that all these people are just sharing something that's not true. So let's just double check them. Let's just give them a little double check-see and see what happens. Let's see if Connor is you know, using actual like facts and useful data points, or let's see if Connor is just, you know, a brain dead moron tweeting out shit that doesn't even make sense and using terms like major bear market sell-off that aren't even quantifiable. So, you know, maybe Connor will respond to this. I'm sure he won't. But regardless, let's take a look. So obviously we know what's going on here because we planned it out ahead of time. So we take our peak right here and we take from the top to the low. So that is, we're on the S&P SPY right now. So we have from the peak right here, the all-time high on the S&P, to our recent low. We have our Fibonacci here in orange. And of course, you guys know, obviously, you know, we nailed the bottom perfectly. And where was our target to the upside? Well, right here in this red box. And where's that at? Oh, look, that's a 50% retracement. So between 50% and the 618. So a 50% to a 61.8% retracement, which for anyone that's familiar with Fibonacci, you know, retracements, that is Charles Dow theory is a 50% retracement. And the 618 is the, you know, golden zone. So the most common bullish retracement. Now, in this case, when I say bullish retracement, I mean, we're in a downtrend. So equivalence of a bullish retracement and a downtrend is like a 61.8% resumption or retracement of the downtrend followed by resumption of the downtrend to new lows. But obviously we don't have to worry about that because Connor has spoken. And it's been, you know, millions and millions of people have seen it and retweeted it. And I'm sure someone has done due diligence at some point in time. So we'll just trust that Connor has, obviously, and everyone else that's retweeted it. But just in case, we'll take a look, just in case. So that being said, that would mean that once we reached 417 on the S&P, that was it. We're definitely not going to ever come back down and put in new lows because it's never happened before. And the only way it does happen is, you know, if we do something we've never done before. So we're definitely not going to look back at this chart and find multiple places, let alone even a single place where we have done something like this before, because it's never happened and then went to new lows, ever, according to Connor. So that being said, hopefully I'm laying it on nice and thick so that people will legitimately actually do their own due diligence, because it's so fucking important. Because in this day and age, so many brain dead, mush people just assume that whatever they see, the title or the article or the tweet or whatever, is true. Therefore, they just buy into the narrative and just assume, okay, that's it. And then they just repeat it to everyone and they repeat it to everyone. But no one's actually putting in the work. So let's put in the work. Let's see how hard it is to see if Connor's correct or if he's a fucking moron. So let's look. What is this right here? What's this one? Okay, this looks like a major market sell-off, right? What was this? Oh, that February 2020. Can't remember what was happening in February 2020, but I think let's see if we went down 20%. See if we went down 20%. Okay, so well, that was 15.7%. So that's not 20%. So I guess we can't call that a major market sell-off. You know, and we also didn't flip the 200 exponential on simple bearish. So, you know, I wouldn't assume that that's what it was. So I guess, you know, if we go to maybe right here or whatever, do we see any substantial bounces along the way? I guess the easiest way to do it would be to take our fib tool. And, you know, obviously this was the Rona dump. My sarcasm out of control this morning. So here we see a 50% retracement from the low to the high. But according to Connor's super vague definition of a major market sell-off in a bear market, I mean, does that count? I guess not, right? So we'll give Connor the benefit of the doubt. So because we didn't go down at least 20%, even though we retraced 50% and then went to new lows, we're not going to count that one, okay? We're going to give Connor the benefit of the doubt. So then the next low, do we see any other big bounces along the way? What about this one? Do we see any big bounces along the way? No. What about right here? Obviously that was the low, and then we never went to new lows. So if we just quit right there, Connor's right. So you know what? Maybe I'm just being a dick. Maybe I woke up on the wrong side of the bed today. Okay? But at least now we can say we're doing our due diligence. So what about this one right here? This looks pretty important. That's a pretty big sell-off right there. You know, obviously this was 2018 peak right there. And again, you know, pretty aggressive sell-off on the S&P. So again, let's do the same thing. Let's see, based on Wall Street definition, let's look for a 20% downside and see if we ever see any 20% downsides. Well, again, that one's, 12% right there. So no 20% downside. So I guess, you know, Connor's right. No major sell-offs. And then here we go down 20%, confirming to a bear market based on Wall Street definitions. And then coincidentally, that's the bottom. So I guess if we just quit right there, you know, Connor is technically correct. He is technically correct. And then what if we just go back again? You know, this one looks pretty big, but I don't know. I guess we could see, does that look like 20%? Probably not. You know, I'm going to kind of speed this up right here so we can just kind of zip through 15%. So not quite according to Connor. You know, looks okay. I mean, this Connor guy might be on to something. So, I mean, as long as we don't see any like further data points down the line or any like big, you know, similar looking scenarios where we have a bunch of the same red flags or like red lights flashing as we do see right now with a potential, you know, 2000/2008 type global financial crisis, you know, dot-com bubble burst, you know, global recession. As long as we don't see anything like that, I mean, we're probably fine. So I think 2008 and 2000 are probably what we have to worry about. And a matter of fact, I'm sure that the first thing Connor did before he sent out that tweet, I'm sure the first thing he did was look and just double check to make sure 2000 and 2008 didn't see anything like that happen, right? There's no way, because I mean, that would just be obvious. That would be the area you'd look at. So here's our peak right here in 2007. And from that peak, obviously pretty aggressive sell-off, a back test, and then a complete meltdown. You know, obviously we would call this a bear market right here. Connor would not call it a bear market, I'm assuming, because he's using Wall Street definitions until we're down 20%. So let's figure out where 20% is, and then let's kind of figure some stuff out from there. So, oh, there's one, 20%. Okay, so wait a minute. All right. So as long as we didn't go and see a 50% retracement after that 20% downside and then go to new lows, Connor is still the man. He's the fucking man. He's always right. He tweeted out to plenty of people, and he definitely did due diligence before he sent out that tweet. And then all the people that retweeted it and put it on their show, those people obviously did due diligence as well. So there's no way that this is going to be a 50% retracement. Otherwise, Connor's a fucking moron. And, you know, on all of Earth, no one did due diligence after seeing this. And we're just seeing this narrative, you know, puked out by everyone, regurgitated by everyone. So let's see. Connor, I'm pulling for you, but I don't know. I don't know, Connor. That looks pretty bad. We definitely went to new lows, so let's just hope we didn't bounce at least 50%. Oh my God. Oh no. Oh, Connor. Oh my God. Your parents would be disappointed in you because you're a fucking moron. Okay, so we dropped 20%. I would say that's a major market sell-off. We're in a bear market based on Wall Street's definition, based on my definition. So everyone has to agree that's a major market sell-off in a bear market. Everyone has to agree because we're comparing it to what's happening right now. So we know based on Fibonacci, we then immediately double bottom right here, and then we push back up. Well, that's 50%. Well, but Connor said it's never happened. A moment of silence for Connor's credibility because it just got killed in 3 minutes. Fucking moron. So Connor said we've never had a major sell-off, 20%. We've never had a 50% or more bounce, and then we've never went on to make new lows. So here we made new lows, and then here we made new lows, and then here we made new lows. And a matter of fact, if Connor had tweeted this out previously and you listened to him from when we hit that 0.5 area and you then became bullish because, you know, Connor said so, obviously, you only lost another 52%. So that's not bad. So sure, he was wrong. Sure, he didn't do his due diligence. Sure, everybody else tweeted out and no one else did due diligence. But I mean, who cares? Because it only went down another 52% after that. But this is a fluke, okay? And maybe his chart doesn't have this on there. Or maybe he just didn't see this on the chart. It's not like it's an important area. 2008, there wasn't anything like serious going on back then. It's definitely not like a similar type scenario to what's happening right now, obviously. So let's just look and just make sure there's no other like obvious ones that are like literally on the screen at the same time as that one. That was just an anomaly. Connor must be using some sort of different metric. I mean, that's the only thing I can think of. So what's the other key time? Oh, okay, 2000. That was an important time. I can think, what was that? .com bubble burst, similar to what we're seeing with like crypto and tech right now. So let's just see if we go down 20% at any point in time. 19%. So, I mean, we'll give Connor the benefit of the doubt. 19.1% is not 20%, and 20% is, you know, the generic definition on Wall Street of a recession or of a bear market. So we're going to give Connor benefit of the doubt on that first push down. But let's look at this one because that's 30%. So is 30% a major market sell-off? I would say yes. Now, I have not reached out to Connor, but I would assume that 30% counts. So even if the 20% doesn't count, you know, and we'll give him the benefit of the doubt, we'll only count 30+%. So we'll massage the data a little bit just to, you know, to make sure that it says what we want it to say. So for sure, there's no way that we're going to see, you know, 50% retracement, obviously. So there's our 30% down, so major market down, and then, oh no, what is this? 50% again? Oh, Connor. Oh no, Connor. So 50% retracement after a major market sell-off in a bear market, according to Wall Street and also my indicators as well. And then what happened after that? Well, we then put in a new low. Uh-oh. Uh-oh, Connor. And then what if we just skip this one and we say, well, we're not going to count that one because, you know, we just don't like it. It's not cool. So we go, okay, so we're okay from here. So as long as we just skip, you know, inconvenient data points, everything's fine. Everything's fine. But what if we don't skip that? What if we say, well, Connor was obviously wrong right here and it went up 50%. And then what if we say, well, let's just take a little fib from the next one. So from the top of when Connor was wrong right here to the next new low that we put in, and then we'll say, do we bounce 50% from there? Oh, we do. Oh, we do. So not only was Connor wrong right here that we drop 20+% and then bounce 50% and then put in a new low, but not only did we do it once, but we then go on to put in a new low, and then again we bounce over 50%. And then what happens after that? We go in to put in a new low. So I mean, I don't know what charts Connor's looking at. I don't know how there's no one else on all of planet Earth that can literally take 5 minutes of their time to just double check and make sure that Connor's correct before we tweet this out to literally, you know, hundreds of thousands or millions of people. But let's just go back to his statement really quick and just take a look and see if maybe we could like dispel, you know, this little rumor. And, you know, if now keep in mind, I like Michael and Ben. I like their show. It's entertaining. They're cool guys. But let's just look at this tweet now again. So it's fun. It's fun, guys. This is fun. We can now say something that's never happened before is going to happen. So it's never happened before. Okay. So either we get inflation down from elevated levels without a recession. So we know that's never happened before, you know, because we've done our due diligence on that in previous streams. So that one off the table. So you're right, Connor. As long as the second one is also true, that it's never happened. So it's never happened before that we have gotten a 50% retracement. Okay, we just checked that. Of a major bear market sell-off, which, you know, 20% I would say is a major market. But we saw at least one with 30. So maybe he's talking about if it's over 40%. Maybe he's talking about 40% corrections because we're massaging the data. And then it goes to make new lows. Well, we literally just found how many examples, and it took us 5 minutes. We saw literally 3 examples. So you have to decide which it is, guys. So do you think it's more likely that of these two things that have never happened before in all of existence, that you can go verify on your own in 5 minutes? Or is Connor a fucking moron, and anybody else who's tweeting this out or talking about this narrative is also a fucking moron? I mean, it blows my fucking mind how retarded people are. It's like full-on sheep. Social media has ruined people's brains. Because the first thing I do when I see something and I'm like, whoa, that's an interesting piece of data, I spend 5 minutes of my valuable time and just go double check it just to see. I do my due diligence. So I encourage each and every one of you to do the same. Because this is the narrative, okay? And I'm picking on Connor right here or whatever. I'm sure he's a nice guy. I'm sure his parents raised him nice. I mean, he has a nice suit on and he's got a blue check mark. So, you know, I'll give him the benefit of the doubt. I have no fucking clue who this is, nor do I care. But I know he's big enough that he's reaching probably hundreds of thousands or millions of people. So, I mean, he's definitely not spreading misinformation, is he? Because I'm sure before he tweeted this out, he must have looked at a chart and looked at it. So maybe he didn't go back far enough. So we're in 2022. Maybe he didn't get back to 2008. Maybe he didn't check the most obvious 2 data points, which would be 2000 and 2008. Maybe he just went back to like 2010. So if this read, let's correct his tweet and make it accurate. So it's fun that we can now say something that has never happened before is going to happen. Either we get inflation down from elevated levels without a recession, or a 50% retracement of a major bear market sell-off goes on to make new lows since 2009. There we go. So it's never happened since 2009. Or we could say it's rarely happened and not put in 2009. Or we could just say that this dude's a fucking moron and this tweet is useless. But, you know, it is what it is. It's not like it was Elon Musk tweeting it out or anything. It's not like it was anyone important. I don't know who Connor is. Maybe you do. But anyway, that's our little stint today on doing our due diligence and why it's so important. Do not trust anything. I mean, all these people are in crypto, in markets and everything. And what is the same thing that you hear all the time? Don't trust, verify. Don't trust, verify. I always hear people saying, don't trust, verify. Don't trust, verify. Well, why isn't anybody not trust verifying? It doesn't even make any sense. It took us 5 minutes, okay? And if I wasn't being so sarcastic and laying it on so thick and being such an arrogant asshole, we could have done it in like 30 seconds. I could have just went right to it and been like, bing, 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 bing. Sorry, Connor. So please, do your own due diligence. Put in the work. Take the time before you bet with your hard-earned money, before you listen to these Main Street narratives, before you listen to these people with giant bullhorns on Twitter or on CNBC or on YouTube channels or whatever. Please just put in the 2 minutes of work and just double check to make sure. For your own good, for your family's good, for your money's good. So anyway, we're going to go back to our regular technical analysis. But I just wanted to, this is a huge narrative right now. And it is being regurgitated everywhere. And it's obviously wrong. So I don't know if Connor's lying. I don't know if he's spreading disinformation intelligently. Or I don't know if he's just a fucking moron. But one of those 3 things is correct. I would say probably he's just a lazy moron. That's my guess. Because I don't think, he doesn't look like a mean guy. I don't think he's trying to fuck people over. I think he's probably just stupid as fuck. And he might be intelligent, but you can be intelligent and also be stupid. Okay? You can have a fully functioning brain and still be a moron. Okay? You can get called a retard by me, but, you know, not have anything like legitimately wrong with you other than you're just lazy bum. You know, because it's a lot easier to make some cute tweet like this than it is to pull up a chart and spend, 5 minutes checking to see if it's true before you tweet it out. So if you haven't seen the one where we essentially verify the first part of this tweet, we did that a while ago. So maybe he watches the channel. I doubt it. But the second part, sorry, Connor. So you have to decide which is first. Well, this one we know is actually true, and this one we know is actually false. So I would say probably just that we do the thing that we've done before, not the thing that we've never done before. But again, that's just, probability says if we've never done something before, we're most likely not going to do it now. But if we've done something multiple times before, especially in similar situations to what we're in right now, it's probably more likely that we're going to do that. So anyway, that's it. I know I'm obnoxious, but I'm just trying to make a point, guys. And it's very, very, very important that you do your own work. Do not trust these people. Do not trust what you read on the internet. Don't trust, verify, please, for your own good. For your family's good. For your money's good. For your sanity's good. Because how would you feel if you said, well, that's it. There's a 0% probability we go to new lows. And then next thing you know, we're at new lows. And then afterwards you go double check that and you go, oh, actually, we did it once in 2008 and twice around 2000. So why did I believe that? Because now I feel stupid. We don't want that to happen. So we just put in the work. All right, so let me jump over in the chat right here and then we'll keep on going. So, all right, UniQ, what's up, man? Good to see you. Missed the start. We'll watch it back. Glad to be here through the Love and Friday live stream. For sure, brother. Glad to have you. T Jeers, what's up, T Jeers? Bit lagging the live stream, but like your thoughts on the Dow Jones. Bit lagging the live stream. I mean, I can't help that, dude. I have like awesome internet and like, I mean, obviously you can see the machine that powers this live stream. And right now it's using like 3% capacity or something like that. So it's probably just YouTube is a piece of shit. T. Gier says, sorry to bother you with my stupid question, but what is the fluorescent colors in the left corner? That's my computer. That's the fucking monster machine that powers this stream. And I promise you, it's much better looking than I am, so. And then T. Gier says, I wonder what's your opinion on the super low unemployment numbers in Europe. Just doesn't match with a struggling economy. Yeah, I mean, well, you have to understand that when you see unemployment numbers, they look one way. But the real metric you should be looking at is essentially labor participation rate, okay? Because unemployment has a bunch of different statistics that can be massaged, and they say, well, this person has been unemployed for 6 months, but they haven't applied for a job within so many weeks, therefore they're not counted as unemployed anymore because they're not actively looking for a job. Even though they don't have a job, because they're not actively looking by those metrics, they're no longer considered unemployed. But they don't have a job, but they're not considered unemployed. So the best thing to do is not look at some BS statistic like unemployment rate and look at labor participation rate. Because the labor participation rate doesn't take into account all your little extra bullshit massaged statistics. The labor participation rate literally takes your age. Are you between the age of, whatever it is, like 16 and 65? Are you between that age? Yes. Are you alive? Yes. Do you have a job? Yes or no? That's what you should look at. So look at labor participation rates, okay? And then you can look at unemployment rates and use the two together. But the labor participation rate will tell you a drastically different story, because you will see that in Europe and in the United States and in many other countries as well, China, Russia, lots of other countries, you will see that the labor participation rate is at essentially like extremely, extremely low levels in comparison to like historical norms going back to like, World War II. So basically, if you disqualify a bunch of people from the unemployment rate statistics by saying stuff like, well, they were self-employed, so they don't count as unemployed now. Well, they were unemployed for so many months, but haven't looked for a job in so many months, so they don't count anymore. Or, all those different things. You're going to start skewing the statistics and it looks like amazing. You're like, oh, 3% employment. That's phenomenal. The economy must be like doing amazing. And then you say, well, what's the labor participation rate? And you say, oh, that's strange. We're at like record highs historically for the amount of people that are not participating in that. So again, statistics can always be skewed to tell the story that you want them to be skewed to tell. So look at something like that, something that's not being fudged. You know, you don't want to have a bunch of exceptions. You want to have like straight up numbers. So that's what I would use. Hopefully that helps. Triple dumps. What's up, man? Been a while. Dumpity dump dump. Been waiting for that dump, I guess, man. Just show back up. All right, so that being said, let's take a look at the Qs. So here we got the triple Qs. So again, exactly what we've been expecting. Now keep in mind, obviously, we don't have all of our targets and everything because I switched over to these per people's request, which is totally fine. But normally we'd be looking at the IXIC. We would know that we bounce off of the 200 exponential and simple on the weekly, and then we bounce back up, and we got, again, that internal retracement of essentially 50%. And we backtested the top of the range. We backtested the 200 exponential, didn't quite make it to 200 simple. So obviously this was our take profit on the way up here. And now that we fit our take profit, everyone else wants to get bullish and start talking about how we're now in a bull trend. But obviously we're seeing weakness on the indicator oscillators. We're backtesting key resistance in a bear market, which we know for a fact, historically, percentage-wise, that is likely to get rejection and then resumption of the downtrend. So another leg to the downside. And then if we look at the Trash Russell, again, same thing, you know, basically bouncing key levels, backtesting 200 exponential and simple, and now, you know, looking very, very toppy here. Hard sell signal, still inside the bullish control zone for now, very close to exiting it. Bunch of red histograms in a row. Still blue slope line, still over the heart line. I mean, we don't want to just say, oh, we're definitely going to new lows right now, but we're definitely going to at least have a pullback and then see what the market thinks. Are people still bullish now or are they bearish now? You know, obviously we don't know, but we have a bias because we're trading with the trend. And clearly we're in a bear market, so clearly the bias is to the downside. And then if we just go sector by sector, XLI, industrial, powerful move back on top of 200 exponential and simple, looking very, very toppy here on the daily. XLB material, again, same exact thing, a little bit weaker, backtesting 200 exponential, rolling over. We see a sell by sell, bearish divergence signal, and some other topping signals as well. So it looks like we can come down here, retest to 21. If we lose to 21, we're looking for 821 cross back to the downside. And then at that point in time, what we're looking for is essentially, you know, backtesting key lows, key areas of support. XLF, again, very, very similar, financial. Again, the same thing, still inside the bullish control zone, but looking pretty toppy. XLY, consumer discretionary, exact same thing, looking very, very toppy. XLK, same thing, looking very, very toppy. Tech, we have a sell by sell, perfect bearish divergence signal, still inside the bullish control zone for now. But I mean, we know the reliability of these indicators, which, you know, if you're new to the channel, which I know I don't recognize a couple of those names out there, you can go get the majority of these indicators absolutely free. If you want to take it to the next level and show your support, you can obviously join the trade group and get access to the master and the upgraded Jewel Thief as well. But there's like 10 other indicators that I've created that are free. So help yourself to those. XLK rolling over. It sure looks like it. XTN transportation, hard rejection, rolling over. Looks pretty damn toppy right here. XLC, I mean, you can't even really say it rolled over because it never started going to the upside. Obviously, by far the trashiest trash of sectors in all existence. XLRE, real estate, hitting resistance, rolling over, sell by sell, not perfectly spaced, but again, you know, a little sloppy, but divergent signal nonetheless. XLP, consumer staples. Now we're into our safety sectors, real estate, consumer staples, healthcare, and utilities. Those are obviously where we run for safety in potential bear markets or recessions. So we see XLP, consumer staples, outperforming. Why? Because this is the stuff people need. This is the stuff people can't cut out of their spending. So you can cut out your discretionaries, you can cut out your reckless spending, but you can't cut out your, you know, food and basic necessities. I mean, you can, but you will die. So, you know, as of now, let's just say it rolled over. We have a lower high, so we're likely to go back down and revisit the lows. We are on top of the 200 exponential and simple, so there's definitely potential. We find support, continue to the upside. But it seems very unlikely, you know, assuming that everything else is going to roll back over. But we do expect that the losses would be less, which is why they're safety sectors. XLV, healthcare. So again, reclaim the 200 exponential and simple. The 200 simple is on top of the 200 exponential. So, you know, back test, everybody's bullish again here because we're back on top of 200 exponential and simple. That's why we don't look at just if we're on top of it. We don't look at just the 200 exponential. We don't look at just the 200 simple. We look at the orientation of them. Is the 200 exponential on top of the 200 simple? That's bullish. Is the 200 simple on top of the 200 exponential? It's still technically bullish, but we're showing signs of exhaustion. Is the 200 simple have a positive slope or negative? Well, we know when it's blue, it's positive. When it's pink, it's negative. Same with 200 exponential. When it's blue, it's positive. When it's red, it's negative. So we have a negative slope on the 200 simple, which is above the 200 exponential. We have a positive slope on the 200 exponential, which is below the 200 simple. So, you know, we're slightly neutral to slightly bullish because we're at least on top of those. But again, it's only just because it's holding up better than other ones. Now, XLU, we've been talking about this for some time. Obviously, this is by far the most, you know, aggressive, strongest sector. We see the 200 exponential back on top. We see both have a blue slope line, bullish control zone, all green histograms, blue slope line, new all-time highs. No surprises here, obviously. XLE, bouncing the 200 exponential and simple. Obviously, we talked about at the beginning of the stream, what was overperforming for the first 6 months of this year. Where were the places you want to be? Where was the money at? Where were the good bull trends going on? They were in the DXY, the dollar index. They were in TNX, the yields, and they were in energy. And then also we saw strength in commodities. So as the energy trade rolled over and we took profits and, you know, sold the top, as the, you know, oil rolled over, energy rolled over, commodities rolled over, as all these things rolled over, what happened? The DXY cooled off, the TNX cooled off, and then we saw a rally in equities. So now it looks like equities are topping. Now we're sure that DXY and TNX are resuming their uptrends. And now we see strength in energy as well as, you know, potentially some strength in commodities. So what's likely to happen to equities? What's likely to happen to the cryptos? What's likely to happen to gold? Same thing that was happening for the first 6 months of the year. So we can just look at that and say, okay, well, they were all going down, so they're probably going to start going down again. And then semiconductors, obviously, this is the, you know, the final horseman of the apocalypse. We know every time semiconductors go into a bear market, a sustained bear market, that it's the end of the cycle, the end of our, you know, cyclical or potentially secular, you know, bull market, and time to go into a long, nasty bear market. So that being said, this is clearly a bearish chart. We have a high, we have a low, we have a lower high, we have a lower low. We have a lower high again. We're below the 200 exponential and simple. They are, you know, essentially sloped to the downside, even though we're seeing, you know, a little flip right here. What's likely to happen? Well, back test, reversion to mean, sell into the reversion of the mean, and then resumption of the downtrend. Bearish. So there we have it. So, okay, so let's go down the checklist. All right. Looked at the basics, talked about the overall narrative, made Connor look like a fucking moron. Put my boys out a little bit. Sorry, Mikey Batnick. Sorry, Ben Carlson. I guess next time do your due diligence. I mean, it is what it is. I mean, DXY, obviously extremely powerful here. We were talking a little bit about in the group here. Obviously, DXY is a basket of currencies, dollar compared to essentially, you know, the euro, the British pound, the Canadian dollar, the Japanese yen, you know, and a couple other much less significant currencies. That being said, when we do the actual breakdown, what we're talking about is essentially looking at the dollar in comparison to the euro. They're essentially trading at parity right now. And when you look at the euro, obviously, because the European Union was, you know, only more recently formed, we don't have the same resistance that we do on this chart. So I should just bring it up, but I'm too lazy. So go do your due diligence yourself. This is basically our DXY chart. And we have a nice, beautiful, you know, history going back to the 1960s. So we have our peak right here, which was, you know, the Paul Volcker moment, 1985. We have our next peak right here around 2000, 2001. So we know after we broke out from our basic double top right here. I mean, we've been bullish on the dollar the whole way up, obviously. We were the only one. Us and Brent. That was it. So here we are. Took out that top, shot up right here. So we know the next area that we're likely to take a pit stop, obviously, is right around here, the previous peak. But the problem with the euro is it doesn't have this part of the chart. It doesn't exist because the euro didn't exist. So once we get up here on the euro and we break out, if we break out above 120, the euro's fucked because we're in a blue sky breakout on the dollar in comparison to the euro. So what does that tell us? Well, there's a land war in Europe right now. They're having serious energy crises. It's a, you know, basically like, I mean, I'm not trying to be like mean. I have a bunch of like followers and friends that live in Europe, but let's be real. I mean, Europe is dying. It's dying. You know, that's aging population, declining growth rate, declining population, you know, economy, stagnant, growth stagnant. So does it make sense that once we break out from here, the US is going to just, explode to the upside in comparison? The dollar's going to explode to the upside in comparison to the euro? It does. It makes perfect sense. And then what about the British pound? What about UK? Same thing. UK typically has traded much more strong than it is right now in comparison to the dollar. And then Canadian dollar we looked at, and we know the Canadian dollar actually is much, much stronger than everything else in the index in comparison to the dollar. But again, the dollar is strong compared to the Canadian dollar. So again, the whole narrative of, if you want to figure out where do you put your money at, you want to look at what currency is strongest. Because obviously all fiat currency is trash. It's all trash. But what is the best trash? What is the cleanest underwear? Okay, all your laundry is dirty, all right? And you got to run out of the house, and you don't want to free ball it. So you got to put on some underwear. Which pair of underwear are you going to put on? You can put on the one with holes in it and shit stains, or are you going to put on the one that is like kind of okay, but it's not like fresh? That's the one you're going to put on. You're not going to put on the dirty, gross one with holes in it, where the like elastics like all worn out from going through the dryer too many times. So it's kind of like falling down and got to kind of hold them up. No, you're not going to do that. So the dollar, that's where we want to be. And where's the dollar? US. So that's why we're not, doing all these investments in, other countries, emerging economies, all these like narratives that you hear. Because obviously they're all wrong. And we know that because we have history. All right, so that being said, let's rip through a couple of these traditional assets, and then we're going to jump into crypto. And I do apologize for my, less than enthusiastic excitement today, just because it's just exhausting. Like, it blows my mind. I know I'm not the smartest person on earth. I know I'm not the best technical analyst on earth. I know there's other people out there that have to at least have half a brain left to do their own due diligence and look at this stuff and do technical analysis and say, hey, wait a minute here, or even fundamental analysis. But no one is doing it. It doesn't make any sense. All the big talking heads, all the people. We expect people like Tom Lee to come out every day and just talk about how bullish they are, and fluffers. You know what the fluffers are. We expect Tom Lee to be a fluffer. That's his job. His job is to come out and get dudes hard. His job is to get you hard. Okay? That's just his job. That's Tom Lee. Tom Lee's job is to make men erect in the stock market, obviously bullish. That's his job. So we expect that from him. But what is everyone else's excuse? I expect it from Jim Cramer. I expect it from Tom Lee. I expect it from, retards in the crypto market that are always bullish. But what about all the other people? What about the people who claim to be technical analysts? They're not, though. They're hindsight technical analysts. They literally wake up in the morning, they go on whatever, Twitter or TradingView or whatever, and they find someone that looks credible or posts a cool chart, and then they take that chart and then they put it out there for everyone to see. Take my charts. Show someone something useful. Do your own due diligence, guys. I know you're doing it, but other people aren't. And that's obvious. It's blatantly obvious. All right, so enough of that. Let's look at some assets here. Talk about some targets, some potential, and what we got going on. So obviously Tesla, much stronger than most things in the market. Obviously very toppy. We have a double top right here. Elon once again dumping on the faces of the cult as expected. Obviously the trade setup played out beautifully, 34% to the upside. Congratulations on anyone that took care of that one. But it does look very, very toppy right here. Now, where would we likely go from here? We would go back down and start retesting some of these key levels. So, we have obviously a high, we have a low, we have a lower high, we have another lower low. And then, now it looks like another lower high. So when we really break this down, and I know there's a lot on the chart right here, but let's just fudge this line right here. We're basically just operating inside of this descending broadening wedge. So whenever we come to the bottom of the wedge, we go to the top of the wedge, and then we go back to the bottom of the wedge, and then we go to the top of the wedge. If we come back down to the bottom of the wedge again, where are we going? New lows. We're going to new lows. So is Tesla going to new lows? It is. Likely going to new lows. Nvidia, again, little bounce right here, but really everybody's bullish. Oh yeah, big moves in semiconductors. But what do we have? A high, a low, a lower high, a lower low. Below these 200 exponential and simple, both are red, negative slope, bear market. What is this? A bear market rally. And what's happening now? Getting rejected and likely to go to new lows. So now is not the time to get bullish. Get bullish like we did down here at the bottom. Get bearish right here at the top. We buy the lows, sell the highs. I think everybody else buys the highs and sells the lows. Amazon, back testing the 200 exponential and simple. It's got this nasty gap right here. Obviously, the double bottom, the W double bottom, bounce up here, slightly underperforming the measure move breakout. But, overall, beautiful. Came back up to resistance. We have a high, we have a lower high, we have a lower high, we have a low, we have a lower low, and we're likely to go put in another lower low. Google, same thing, same chart. Microsoft, same thing. Obviously beautiful trade setup again. Percentage-wise, 15%, whatever. It's worth getting out of bed for, but, we could do that in a day on, our best investments like Bed Bath & Beyond and some of the other key core components of our portfolio. And if you are new to the channel, obviously, and you're not familiar with my level of laying on the thickest sarcasm in all of existence, that is obviously it. So Microsoft, again, same thing, just starting to roll over here. Everybody's getting excited, but what is it? It's a high, a low, a lower high, a lower low, a lower high. Lower low is next. Unless we break out, but doesn't look likely. Apple, again, everyone very, very bullish on Apple right here. What's the Apple chart? High, low, lower high, lower low, lower high again. So why is everybody so, everybody's talking about new highs on Apple, $250 price targets by end of year. Let's put in, let's start small, okay, with Apple. Let's put in a higher high first. And then we can talk about all-time highs and blue sky breakouts and $250. But until we put in a higher high, let's not worry about that. Let's talk about, hey, we need to keep marching this up. Now, you guys know I don't like the term like manipulation and all that crap, but, this is clearly price action being marched to the upside. So if we don't break out from here, it's going to be very clear in hindsight that, somebody basically just essentially like painted the tape, trick people by pushing all the way back up here. Because everyone's talking about new high now. Apple's the biggest company on earth. So what's going to happen when Apple sells back up? What is the market going to look like if Apple decides to go to a new low? Another 25% downside from here just to retest those lows. What is that going to do to the markets when Apple, Microsoft, Nvidia, Amazon, Tesla, they're basically the things that are holding up the entire market. So what's going to happen to precious Kathy Wood's ARK fund? The first time we went from all-time highs in Apple to, down 25%, ARK went down 90% or whatever, or 78. I can't even remember. So what's going to happen this time? It's already still down like 80% from the highs. So what's going to happen if Apple goes down another 25%? ARK's probably going to go down another 50 or maybe another 75. So just please be very, very careful of being in risk-on assets right now. Now is by far the number one most important time to protect and preserve capital. There will be plenty of opportunities in the coming days, weeks, months. But just, as just a basic kind of like, hey, it's now like a stable time on planet Earth, or is it like a little crazy? Well, we have a land war in Europe. That's kind of a big fucking deal. We have a potential war possibility, likelihood, whatever, between China and Taiwan. That's definitely a big deal, especially considering Taiwan manufactures like 95% of, the semiconductors on Earth. And part of the reason we're having supply chain issues is because of, semiconductors, of course. And then we take into account, like 40-year high inflation, double-digit inflation prints in many, first and, third world countries or emerging markets versus established Western countries, however you want to word it. That's a big deal. We have essentially the first time in a 40-year down cycle that we're potentially talking about quantitative tightening instead of quantitative easing. We have a bunch of crazy stuff going on. We have a 40-year downtrend in rates, which corresponds with, a 40-year uptrend in the bond market. So if bonds start rolling over, we know the size of the bond market in comparison to, basically any other asset class on earth is like kind of a big fucking deal. So that's worth paying attention to. So again, we got to be careful of this recency bias. We have to be careful of it. If you're listening to someone that still has pimples or can't grow facial hair, I'd be real careful. Be real careful, because they probably weren't even alive. No, we know they weren't alive during times that were at least kind of similar to what's going on right now. We don't have any times that were historically like the same, but we can at least look at some times that were kind of similar. You know, you could say, okay, let's look at like the 1930s, 1940s. Let's look at like the 1970s, 1980s. Let's look at, you know, 2000. Let's look at 2008. Let's look at some things that have some kind of like similarity. And I think that's going to say, hey, now is the time to protect, not to get greedy. All right, so that being said, let's look at some cryptos. So obviously I told you guys, for all the group members out there, you guys obviously know in real time, but I told you on the last stream that I sold into the pump. Sold like just over 25,000. So literally sold like the tippity top. Look, we get lucky sometimes. When you get lucky consistently, that's when you start talking about, you know, hey, we're doing something right here. So we did sell the absolute tippity top. Broke down from key levels. We were looking at essentially, I think we have to look at the other chart actually. We'll look at the spot chart in a second and then talk about that because I broke that one down like in like crazy detail last stream. So if you didn't check that one out, go back and watch last stream from Wednesday and look at the Bitcoin technical analysis and then see like, hey, does it look like that's playing out exactly like we said? Or were we saying we're going to new all-time highs? So I think you'll, I mean, you guys know. So this rolling over right here, we're very close to confirming the daily 821 cross to the downside, obviously bearish. We're still very much in a bear trend. Bitcoin and crypto in general have drastically underperformed, as we see basically every sector in the stock market and major, you know, index that we looked at is backtesting the 200 exponential and simple. Some of them even got back on top of it. Consumer staples, you know, energy, still above them, still in a bull trend. Utilities at new all-time highs. Look at crypto though. The most risk-on asset, and we just had like the most aggressive dead cat bounce of late, and many things came up, you know, 20%, 50%. We saw assets pump, you know, 300+% from the lows. And look at Bitcoin. Look at this trash asset right here. Keep in mind, I don't hate Bitcoin. I'm just saying the chart is trash. I mean, look at this. Look at this pathetic underperformance. I mean, this thing should have had, let's just, if it was just going to be at par with some of like the regular stocks, we should have seen an 80 to 100% move to the upside. Instead, we saw this pathetic little 34%. I mean, which is great for my portfolio. I obviously love to capture 30+% moves to the upside. But I mean, let's be real. Crypto is drastically underperforming. So looking at this chart right here, it's pretty obvious the level that we're looking at now. The key level to watch is 20,000, like 900. We don't want to see a new low, a lower low right here. But if we do, it's not just like all of a sudden we go to zero and that's it. Because we have a higher high right here. So what we need to do is put in a low, and then we need to come back up and then put in a lower high. And then we can worry about a lower low. But taking out the previous low right here is important, but it's not nearly as important as establishing a trend back to the downside. Because once we're here and we have a low, then a high, then a higher low, then a higher high, then a higher low, then a higher high, then a higher low, then a higher high, we're in a, you know, pretty clear uptrend. So we'll look at the supports here and the ascending channel in a second on the spot chart. So, well, we can just go do it right now. We don't really need to look at CME. It's nothing really important there. So, all right. So I don't even remember what we drew on this last time, but I know it was pretty important. Oh, you know what? I think I deleted everything at the end. Oh no, because we did the we did this chart. Oh, which I also posted up that Bitcoin rainbow indicator in the group as well, and you know, defunked that and essentially showed how that is complete trash, and we have actually fallen out of the bottom of it. So in the last year or whatever, we basically have perfectly identified in advance that Cathie Wood is a charlatan, trash loser, and literally loses like hundreds, well, maybe not hundreds, double-digit billions of dollars for investors. So we're able to identify her fraud. Michael Saylor, obviously, we were able to base him out and make him look like an absolute fool as he's upside down in his billion-dollar borrowed leverage crypto position. So another charlatan destroyed. And then what else? The Bitcoin rainbow indicator is obviously trash. We destroyed that one as well. And then Plan B, stock to flow ratio, destroyed as well. So all of these hindsight things, like, oh, Cathie Wood kills it in hindsight, right up until she doesn't. Oh, Michael Saylor's a genius. In hindsight, not anymore, because obviously his cost is way, way, way above where Bitcoin's at right now. I mean, he's down 33% almost in a multi-billion-dollar position, and still going on telling people how intelligent of an investment it was. Well, if it was so fucking intelligent, why didn't he just wait to invest and then buy now? Think about how much more Bitcoin he could have, because he doesn't know what he's talking about. He's a moron. If he bought gold, he wouldn't be down 33%. So I guess if Michael Saylor is actually an intelligent human being, he'll just be like, well, you know what? Actually, gold is the way to go, and I was wrong. And I'll admit that I was wrong, and then I'll just go buy gold. Is that going to happen? No. Is that a good choice to do anyway? Probably not. So anyway, Bitcoin on monthly, I guess we'll just break it down. We'll just go to shorter time frames and just we'll redraw this chart again. All right, so from our peak right here, obviously to our low right here, the key things that we're looking for are key Fibonacci levels. So we have our peak right here to our low right there. We bounced up, hit the 236. And very clearly here on the weekly, we can see once we hit the bottom, we back test the 236, we're getting rejected. So one of two things is going to happen from it right now. We're going to come down here and put in a higher low, and then we're going to continue up to the 382, which is definitely a possibility, which would be at 30,000. Or we're getting rejected at the 236, we're going to revisit the lows right here, and if they don't hold, we can go to new lows. We don't know for sure which one's going to happen, but there's some pretty good ways we can decide, or we can, figure it out. The other key level we're looking for is basically this previous swing right here from that leg down, and we'll turn this one orange. And then again, we almost made it to the 382, but we fell kind of short right there. So now we're already below the 236, so we know that's not going to hold unless we pump back up here. By the end of whatever the week, we're on the weekly right now, but let's say by the day or whatever, we don't want to close below 22,150, or it's going to look like we've lost this level as well. But obviously, the key thing that we're paying attention to going on right here is, our base case unfolding perfectly, which is basically, I'm going to use the actual tools for it. What do I want? I want the fibs, or the Elliott waves. So we know the base case, my base case for literally months now that has been playing out, perfectly, is essentially the 5-wave structure to the downside. And, obviously that's all part of the expanded Elliott wave flat, blah, blah, blah. You can go back and look at all that and all the, again, it's all posted up in the group, or I'd have many of the streams on it as well. But essentially we're looking at 5 waves to the downside. So we have our first wave to the downside, then we have the retracement of that first wave. So we're going to look for some similarities on the chart. So obviously we back test to 0.5. So we had a 50% retracement after the sell-off. We'll get rid of that one. And then we're just going to do the same thing again. So then from the 2 to the bottom of the 3, so that was our next leg to the downside, or our impulse to the downside, and then we're bouncing up, and we're basically falling just slightly short of the 382. So would it make more sense if we hit the 382 and rolled over? Yes. Would it make even more sense if we made it to the 0.5 and then rolled over? Yes. So that's why we don't want to get overly bearish right now. We know the maximum that we could get up to is essentially like that 34,000, because after that, we're retracing inside of the 1, which violates our rules. The 4 can't be inside the 1 on a highly levered market, on longer time frames, et cetera, et cetera. So 618 is a potential target. The 0.5 is, the likely common target. The 382 is what we should have hit for sure. Is it possible we go down from here and that's it, and we just get our next leg down? It is 100% possible, but there's still potential that we actually do come back up just slightly higher and retest the 200 exponential, retest the 382 or the 0.5, and then go lower. So we don't want to take that off the table yet. And then our potential target to the downside, again, we can take from the low right here to the top of the 2 right there. And then we can look at where the extension takes us to. And we know from the high right here, I'm going to turn that one yellow. We know from the low right here to the high right here, coming back down to the low again is the 1. It's a 100% move, equivalent to the previous move. And then after that, it's a multiple of that move, or Fibonacci extension, which we see here. We literally come down to 2.618. God damn you, TradingView, you piece of fucking shit. Oh my God. Fuckers. Not enough memory to open this page. What in the actual fuck are you talking about? God, I hate TradingView. All right, give me a second, guys. I don't know what the hell is going on here. What the fuck? I promise you it has nothing to do with my actual computer's memory. I have no idea. I mean, something to do with TradingView just not liking, like, me in general, let alone having all these charts, I guess. I don't know. So fucking annoying. Not like we're like doing a stream or anything important. Okay, so anyway, so the fib extension to the 2.618 perfectly, obviously, you know, a pretty big deal. So hit that to the T, and then pushing up here potentially to the 382. So then let's just assume that that is topping out right here, and we'll just do the same thing again, and we'll just assume that this move is topped out, and we take from the low to the high right there, and then we can look for our fib extensions. We would expect potentially a target of the 1.618, or possibly like the same one, the 2.618. So that would give us a $9,300 Bitcoin, or a, you know, $13,900 Bitcoin. So we don't know which one, obviously, but, you know, potentially one of those two. And then obviously we talked about also on the last stream here. Let's go ahead and delete some of this trash. Man, I don't know what it is. I feel like there's a forever battle going on between TradingView and Brave Browser. It's like TradingView hates Brave Browser, so it's just always like at war. I don't know. That's the only thing I can think. Wait, no, even the one day I switched over to like standard browser and it did the same thing. So I don't know. I don't know what it is with TradingView, but it's annoying as hell. So let's go over to our daily chart. So again, let's just assume that we're rolling over right here. What do we need to pay attention to? I'm going to get rid of this as well, just to make it simple. All right, so what we're looking at right here is essentially, we were talking about this situation. So we basically been in this ascending channel right here, which obviously is a bear flag. So we had a leg down, we had a flag up, and then we break down and to a new low. And then we obviously have our leg down, and then we consolidate to the upside, and then we break down from that. We begin the next leg to the downside, the resumption of the trend, which in this case obviously is bearish. So losing this key support right here was very important. The reason we were able to identify the absolute top and sell was because of bearish divergence. So we basically were able to nail the bearish divergence on multiple time frames. We had actually quad bearish divergence on the 4-hour, and that's why I sold into that 25K pump. And then we talked about this area being the pivot, because essentially if we found support right here, we could easily move back up to the heart line or the top of the trend. But if we break down from here, we're likely to get the resumption of the trend. The initial move to the downside would, of course, be the measure move from the top of the channel to the bottom of the channel. So the initial move to the downside, which again, we don't have to do in just one leg or anything, but you know, we're halfway there right now, would basically take us back down to 19,275. Now that's just a retest of this previous low right here, but the most important thing, the most important level that we're paying attention to for, is this trend still like potentially intact here on the daily, we would look at this level right here. And we know as long as we're above that, we at least have a low, then we have a high. Then if we just close anywhere above this and then start moving back to the upside, we'll have a higher low. So then we can still put in a higher high and it's not over. Now losing this channel, obviously very important. Losing, you know, the blue slope line right here, breaking down below the zero line, very important. You know, obviously the knife is very aggressively stabbing to the downside. It's basically at like zero right here. So we're seeing pretty big moves, but you would expect to get that when you break key support. So keep in mind the knife, you know, obviously proprietary, but the knife is a leading indicator. So when we peaked out right here and then it starts to roll over, look where the knife actually like has its trough, okay? We have a big aggressive move. So that's like the low on the knife, but we still go much lower after that. So we don't want to get aggressively bullish right here, trying to scalp a move back to the upside just because we see a super deep knife. Because oftentimes, and what we're looking for is, we're looking for the knife to put in a low and then come back up. And then we're looking for it to come back down and put in a higher low. And we're looking for bullish divergence on the knife, the same way we would look for it on the stochastics or, you know, the TDMACD or one of these other indicators. So breaking down from this channel, obviously very important. We had a bunch of other things drawn in here as well. So internal, like, you know, ascending wedge and all that, but none of that matters anymore because we broke down from all that. So, and again, you know, the magic 8 ball has served us well. Is it going to keep working into the future? I don't know. I'm not sure how much magic is left in it. I know when I rubbed the lamp and the genie came out and I got the 3 wishes, I wasted 2 of them on dumb shit. And then the third one, I got the magic 8 ball, but he wouldn't let me wish for more wishes. And he didn't tell me how long the magic 8 ball is going to work perfectly for. So I don't know, guys. You know, we've wore that thing out. So we'll see what happens, but I don't know, man. Could any minute could just run out of magic. So we'll see what happens here. Obviously, we have key areas to watch out for. Losing this support right here is kind of important, but not really, 21,200, because we did put in a high right here. So until we put in a high, then a low, then a lower high, it doesn't really matter. Losing this area, it's support, but it doesn't really matter. The most important thing is when we do eventually get a bounce, which we almost always lose a key support area and then get a bounce and back test that key support area. And then we'll see, does it get rejected? And then we go lower, and then we have a high, then a low, then a lower high, then a lower low. And that's my base case. That's what I would expect to happen because that's what happens most of the time. So essentially at some point in time, let's just say this bottoms out right here. We would expect to get a push back up to retest the breakdown or a back test. So it was support, we back test it, it acts as resistance potentially. And then after that, we get continuation to the downside, you know, which obviously would take us down to the measured move. It would take us down to that potential downside. We would then say we were in an uptrend and now we're potentially in a shorter term downtrend. But the truth is, as long as we stay above that yellow line, we still are technically in an uptrend here, but obviously macro, we're still in a downtrend. So it's all about perspective and time frame and what we're looking at. So that being said, you know, obviously losing that area is important, but I wouldn't get too bearish right here. What we're actually looking for is probably like selling back into the next pump up when we see signs of exhaustion, which again, we'll look for bearish divergence or something like that. In real time. And over the weekend, anything can happen. We could get a big bullish move over the weekend. We could get a big bearish move over the weekend. But we know statistically speaking, by Sunday when future opens, that likely Bitcoin is right back where futures closes at within, give or take, a couple percent. And, you know, we're looking to arb that trade. If we see futures close and then Bitcoin gets super bullish, we're looking to short back towards the futures close, you know, over the weekend after that big bullish move, and vice versa. If all of a sudden Bitcoin drops to 18K again over the weekend while futures is closed, we're looking along that low to get back up to where Bitcoin closed at on the futures chart and just take that. It's like free money, a little bag of money sitting on the ground. We go over, double check that nobody's like watching us or anything. We pick it up and then we just walk away with it because that's ours now. Okay. All right, so that's it for Bitcoin. Not going to go on like super detailed look right here. I mean, it's pretty obvious what's going on here. I guess we could look at a shorter term time frame and talk about a potential scalp. Obviously, none of this financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research. Trade responsibly. You know, if you listen to anything I say for anything other than entertainment purposes only, you know, obviously you will end up living in a van down by the river. We know that. We know that, obviously. All right, so what do we got going on here? So we got a buy signal, we got a sell signal, we got an aggressive knife signal right here. We're consolidating at the lows, not what you want to see. You typically want to see some kind of aggressive bounce. All red histograms, so nothing on the 4 hour right here. We lost the 200 exponential. It is flipped bearish. It's about to cross below 200 simple. Unless we get that aggressive move back up here, we're going to confirm back into a bear market on the 4 hour. So we know right now we're in a bear market on the daily. We're very close to confirming into a bear market on the 4 hour again. We're in a bear market on the 1 hour. We're in a bear market on the, 15 minute. So, I mean, it's bearish as fuck. So that's, I guess, the perfect time for us to get some kind of like slight short-term bullish bounce. And again, you guys know I don't like looking at these short terms on stream. But if we look at the hour, are we seeing some exhaustion right here? Let's take a look. So we see this very aggressive knife stab down here that corresponds with that initial breakdown, the loss of support right here. We see a little consolidation, and then we see another leg down. And then what do we see? We see a higher low on the knife. And then from then we just melt down and fill that gap. We basically have like this wick get bought up and then rejection, and we just come all the way back down to new lows. So is that just a squeeze for the people that long the bottom? Got aggressive right here? It probably is, and then we likely go higher. We have 2 green histograms on the day or on the hourly, and we have the knife above the stochastics. The blue stochastic tried to cross up, got rejected, came back down, back test the lows, and then potentially we get that cross, we leave the bearish control zone, and then that would correspond with that move back to the upside. So is this a tradable move right here that we have right here? Well, let's check. If our potential target is a back test of the support that we lost, a 7% move to the upside. So, can we take a tight stop and say, hey, if we go any lower from here, put in a new low, we'll get out. But there's potential for, 7%, and then see, obviously we would be counter trend trading. So we're clearly in a bear market on all time frames, with the exception of the 4 hour, which is about to confirm into a bear market. So we take a super tight stop loss, 1.5%, because we're just at the lows right now with a 7% upside target. It's 5.4 to 1. Now, what probably happens? Probably get stopped out. But, we could take that same trade over and over 5.5 times. And if we're right once, we break even. If we're right twice, we're up. If we're right more than twice, we did it. We're way up. So there's definitely potential for a move right there. We'll see, though. I mean, do we come back down and put in a new low? It's tough to tell right now. We're definitely seeing some signs of exhaustion on the shorter time frames. But wouldn't get too excited on bullish moves right now. But typically when we have an aggressive move like that to the downside, it's followed by at least some potential move back to the upside. So, man, this is so fucking annoying. I hate TradingView. It's such garbage. Or whatever the glitch is that decides to F me on all my charts. So annoying. I'm tempted to just wrap it up here at an hour and a half. Let me jump in the chat and see what's going on here. You guys have anything in particular you want me to look at on this stream? Because I'll probably just cut it short because I'm just annoyed by TradingView. All right, so TJ says, sounds like it's yes. I got stop losses on everything. Well, he just made Connor famous for me. Famous for all the wrong reasons. He's the most famous moron that I talked about on this stream. No, he's not. Michael Saylor and Kathy Wood definitely take the cake. What time is it? Crypto Trend Trader Friday stream time. Yeah, what's up, Andreas? Good to see you, man. Jay Hoff says, bears don't get airtime. Of course not. Triple dumps when especially not on like CNBC and shit like that. But I mean, there's no reason on like things like Twitter or, whatever other social media platform or whatever, that people shouldn't be out here talking about like real life stuff. Or, same thing with crypto or YouTube. We were talking about how, there was a couple of people that I actually respected in the YouTube space that essentially sold out because the second they start saying bearish stuff or whatever, the community pushes back on them and gets pissed. And then the cult starts getting mad at them for saying mean stuff about crypto or calling their kids ugly, whatever. And then next thing you know, they're like, well, actually, it probably is bullish and I was wrong. I looked at the wrong data points, or I was on the wrong chart, or, I, drank the night before, so I had a hangover and actually, my TA was off. So you could tell that they're basically just conforming to what people want to hear, which is great if you want views and to monetize your audience. Sure, that's great. But if you want to actually help people learn, if you want to actually help people make money, learn how to do technical analysis, provide like useful service, teach people, help people like have a better life, you got to stick to your guns and do actual technical analysis and not just tell people what they want to hear. And that's the problem. That's the problem with the whole world today, is everybody telling everybody what they want to hear instead of telling people the truth, because the truth hurts. Triple Dump says, when I pull fibs on log and linear chart, I get totally different picture of price action. I see that you only use log. Is log more accurate or is it just preferred? Well, here's the thing about log versus linear scale. log scale is important if you're seeing high volatility. So traditionally, when you're looking at like stock markets and stuff like that, people will use linear scale. And it's important that you make sure that when you're on linear scale and you draw a fib, that you select the box, which actually I can just slap a fib on real quick. I mean, TradingView willing, maybe we can use it. Oh, thank you, TradingView. I appreciate your graciousness of allowing me to use a single chart on stream. I appreciate that. If you go down here to the bottom, if you're on linear scale, you need to unselect this box and put fib levels based on log scale. And then if you're on log scale, obviously, you need to select that box. And then your fibs will be accurate. If you have it incorrect, if you're on log scale and you don't have this selected, your fibs are going to be off. If you're on linear scale and you do have this selected, your fibs are going to be off. So make sure that's correct first off. But the reason you use linear is for less volatile assets. The reason you use log is for like more volatile assets, because instead of using dollar amounts, you're using percentages. So you get like a much more accurate view. Now, with the increased volatility in the stock market and like the insane move that we saw basically from like the peak before Rona to the Rona lows to the, new all-time highs, because it's been so volatile over the last couple of years, I've just basically been using log for everything. And it's been working out, much better. Is it a bad thing to look at linear scale here and there? Not at all. But I think log has, it's proven to be essentially flawless. So I just always use log at this point in time. Every once in a while I'll pop up linear, but the log is just crushing it right now, so I don't see any reason not to. J Hoff says triple dumps, put the chart in log, draw a fib, then go into the setting. Yeah, there you go. Thanks, J Hoff. Make sure the fib level is based on log scale boxes checked. Yes, that's what I love. When you guys teach each other, you don't even need me anymore. That's what's up. J Hoff, assuming you're using TradingView. Yoda, what's up, Yoda? Good to see you. A good weekend, wish you I do. Great information you always share. You think. You crack me up, dude. And then Big D, what's up? Hey, y'all. So yeah, I guess we'll go ahead and just wrap it up there. I'm obviously a little bit annoyed, but it is what it is. You guys know what it's all about. You know what's happening here. You know to do your own due diligence. We obviously have dispelled another, I don't know what to call it, market lie or whatever you want to call it. But yeah, we'll go ahead and wrap it up there. I appreciate everybody tuning in today. Hopefully you guys enjoyed the stream. Please do your own due diligence. Even if you do it and it's correct every time, at least you get the practice of, learning how to do stuff, double checking, verifying, trust not verify, all that good stuff. Yeah, do your due diligence. Obviously, you could expect some excitement over the weekend. I will be active in the group. Probably not on Saturday night, but over the weekend will definitely be going to be some volatility, and should be able to at least scalp out a couple nice percentages. Obviously, you guys know based on what we disclosed in the group and the Wednesday stream that I have closed out all of my crypto positions, taking profits at the absolute tippity top. Fortunately, and the beauty of having accountability via the trade group and also the stream is that it's all there for everybody to see in advance. So if I tell you I'm selling at 25K and then we go to 32K the next day, I look like a moron. If I tell you I'm selling into the 25K pump and then we top at 25,200, I look like a genius. And I'm not trying to look like a genius. I'm trying to make money, and you guys know what it's all about. So the important thing is credibility. You don't see me deleting anything. You don't see me editing or going back and changing everything. It's here for everyone to see. We have a nice track record. We have a consistent, trading plan. Obviously, do the same thing over and over again. And you know what? If you've been around for any amount of time, you know it works. You know it works because we got the receipts. So I'm going to go ahead and wrap it up there. Everybody have a great weekend. Obviously, none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. It is Friday, 12:41 p.m. Eastern Standard Time on August 19th, 2022. Crypto Trend Trader, and I am out of here.